What if I told you that every national crisis, every recession, every panic, every sudden market collapse has a predictable winner? And what if that winner isn't a country, isn't a corporation, isn't even a billionaire, but a loophole? A loophole so deeply woven into the financial system that even most economists never talk about it. A loophole that allows a tiny set of institutions to turn national emergencies into windfalls legally, quietly, and consistently. Most people believe banks suffer during crises. They imagine panic, withdrawals, fear, instability. But what if that's only the surface story? What if behind every crisis lies a mechanism engineered over a century ago that converts national chaos into private profitability? Today, we're going to lift the veil on that mechanism, because once you understand it, global economics suddenly looks less like natural cycles and more like a business model. This is the story of the secret banking loophole that turns national crises into profit, and it begins long before the modern world existed. Our story starts in the late 19th and early 20th century, an era of industrial empires, railroad booms, and financial panics that wiped out fortunes overnight. Back then, banking was chaotic. Local banks printed their own notes. Runs were common. Cities collapsed overnight. But a small group of financial architects, economists, and political influencers were watching closely because they saw in this chaos an opportunity. Names like Paul Verberg, J.P. Morgan, Nelson Aldrich, Frank Vanderlip. Men who understood that controlling money wasn't nearly as powerful as controlling the conditions under which money is needed. In 1907, a major banking crisis struck. It looked unpredictable, but to these insiders, it wasn't a crisis. It wasn't a crisis, it was leverage. J.P. Morgan himself famously stepped in to save the system, orchestrating private bailouts that stabilized the economy. But this heroic intervention wasn't charity, it was proof. Proof that whoever controlled financial support during a crisis controlled everything else. And so an idea formed, an idea kept quiet from the public, wrapped behind technical language and patriotic messaging. If crises were inevitable, why not build a system where banks benefit from them instead of fearing them? This idea would come to life in 1913, through late-night negotiations, through closed-door meetings on Jekyll Island, through legislation written faster than Congress could read. The Federal Reserve System was born. But buried inside its design was the loophole, a mechanism that few understood, a mechanism that would transform crises into profit machines. And it all began with a single principle. Banks should never be allowed to fail, but governments and citizens can. To understand the loophole, you need to understand the architecture it depends on. There are three pillars. Pillar 1, banks create money through debt. This means every loan expands the money supply. When economies grow, banks profit. Simple, but the real twist comes later. Pillar 2, when banks fail, the government steps in. Unlike ordinary businesses, banks operate with protection. They can take risks knowing someone else, taxpayers, will absorb catastrophic losses. This creates what economists call moral hazard, but in plain English it creates a safety net for bankers and a trap for everyone else. Pillar 3. During crises, central banks inject liquidity. This is the loophole, the secret lever. In normal conditions, the Federal Reserve acts like a regulator. In crises, it transforms into a profit generator for the banking system through emergency lending windows, asset purchase programs, interest rate manipulation, guaranteed liquidity lines, quantitative easing. These tools sound technical, but their effect is simple. Banks get money when they need it most, at prices no ordinary person could ever access, and better yet, crises dramatically increase demand for loans, bailouts, and liquidity. In other words, the worse the crisis, the more profitable the rescue mechanisms become. This is the core of the loophole. Not illegal, not hidden in paperwork, but buried inside the design of modern central banking, a design that makes crises opportunities. After 1913, crises didn't go away, they multiplied. But with every crisis, the loophole grew stronger. Let's walk through the cause and effect. The Great Depression, banks collapse, gives government intervenes, gives banking system gains new powers. Deposit insurance, centralized control, and liquidity injections were introduced. Every reform was marketed as protection for citizens, but each reform also expanded the safety net for banks. 1971, the end of the gold standard when Nixon closed the gold window. Dollars stopped being tied to physical reserves. What replaced gold? Debt. From then on, the global financial system became a debt-based system, and central banks gained almost unlimited power to create money during crises. meaning the loophole could now operate without physical constraints. 1980s, 1990s deregulation era banks lobbied intensely. Regulations loosened. Financial products multiplied. Derivatives, mortgage-backed securities, credit default swaps. Every new instrument increased risk and increased the potential profit during crisis-driven rescues. 2008 financial crisis. This is where the loophole fully revealed itself. Banks sparked the crisis. Banks nearly collapsed. Government stepped in. But instead of banks paying for their decisions, the public paid, and banks were rewarded. Here's why. The Federal Reserve bought toxic assets. Interest rates were slashed to near zero. Big banks acquired competitors for pennies. Liquidity injections exploded into the trillions. Bailouts stabilized institutions but not households. This was the loophole in its purest form. The crisis created the profit. The bailout delivered it. Something changed after 2008. Crises weren't just events. They became features. The system had reached a point where banks knew they couldn't fail. Governments knew they couldn't afford bank failures. Central banks knew their primary job was crisis response. Investors learned to expect bailouts. This created the most dangerous feedback loop in economic history. Risk leads to crisis, gives crisis leads to rescue, gives rescue encourages more risk. The loophole became the engine, and like any engine, it started accelerating. While banks profit from crises, someone must absorb the downside. And that someone is almost always the public. Here's what the loophole creates. 1. Permanent inflation. Rescue money expands the money supply. Prices rise. Wages lag behind. 2. Growing national debt. Governments borrow to finance rescues. Future generations inherit the cost. 3. Asset inequality. Liquidity injections flow into stocks, bonds, real estate. These benefit the wealthy far more than average citizens. 4. Currency dilution. When money is printed, its value erodes silently. Savings lose power without anyone touching them. 5. Privatized gains. Socialized losses. Banks keep profits. Public absorbs losses. This is the real legacy of the loophole. Every decade, politicians promise reforms, stricter regulation, better oversight, transparency measures, risk controls, consumer protection laws, but nearly every fix fails. Why? Because the loophole isn't a rule. It's not a practice. It's not even a policy. It is the structure. You can't remove it without dismantling central banking, fractional reserve lending, government-backed liquidity. Debt-based money creation. Reform never works because reform never addresses the foundation. The system was designed to stabilize banks at any cost, and it works brilliantly for them. Look at any crisis in the last 20 years, and you'll see the same pattern. Gives 2008. Mortgage collapse. Banks trigger crisis. Gives banks get bailed out. Gives 2020. Global pandemic. Economy shuts down. Gives banks receive massive liquidity support. Meanwhile, small businesses closed. Millions lost jobs. Markets surged. Financial institutions had record profits. Gives 2023 to 2024. Bank failures and rate hikes. Silicon Valley Bank, Signature Bank, and others collapse. Panic spreads. What happens? The Federal Reserve opens a new lending facility, guaranteeing liquidity even on assets losing value. Banks get rescued again. By 2025, global debt hits unprecedented levels, but bank balance sheets, stronger than ever. Shocking data mirror the pattern. Global debt, over $330 trillion. U.S. national debt, over $34 trillion. 40% of all dollars in existence were created in just a few years. Top 10% own 89% of all stocks. Average savings account earns less than inflation. Bank profits hit multi-decade highs during crises. When crises hit, citizens lose, banks gain. The loophole continues. The pattern couldn't be more obvious. 1. Crises are not interruptions, they are profit cycles. The structure of modern finance turns national emergencies into opportunities for those who control liquidity. 2. The banking loophole isn't hidden, it's systemic. It sits at the center of central banking design, a mechanism where losses are socialized and gains are privatized. 3. The debt-based global system can't be fixed, only understood. Reforms don't change the incentives, and incentives shape outcomes. As long as the world runs on debt-based money, as long as central banks act as crisis insurers, As long as governments depend on banks to fund deficits, the loophole will not close. In fact, it will grow, because the next crisis, whatever form it takes, will likely generate larger bailouts, larger liquidity injections, and larger transfers of wealth than any before. Understanding the loophole isn't just knowledge, it's protection. If you want more deep dives into how the financial system really works, not the polished version, but the hidden structure underneath, make sure you subscribe, turn on notifications, and share this video with someone who still thinks crises just happen. The truth is bigger, darker, and more engineered than most people realize. This is the system we live in. The question is, will you learn how it works, or let it work on you?